Good evening. How's everyone doing tonight? Is this probably one of the best client dinners we've had yet so far? I don't know. I mean, all the people that say, there's some people that say, yeah, we don't like the theme. We don't want to come to the theme. You know what? They don't know what they're missing. But next year, I promise we'll have a no-theme event. It'll probably be at Mohegan. I know. All right, so let's hit some of our regular traditions, being that this is the 12th annual client dinner, which I think is pretty awesome. In the category of furthest traveled, the folks who have traveled the furthest to be here would be my mom. All the way from Cortland, Ohio, Becca and her husband, Del. And second, in keeping with our tradition of measuring market performance from client dinner to client dinner, which I think is kind of a good way to mark this because you can remember in our minds where we were last time. And last time, remember the Game of Thrones theme, the medieval thing out at St. Clement's Castle? Around about that time, the market was at the Dow was at 35,000. And today we're roughly at 40,000, and I note we dropped 400 points yesterday. How many today I didn't see, but we dropped, I know we're down today again today. So lots of volatility. And as predicted, lots of volatility. A whole lot of sideways movement in the market, but not real forward progress when you measure it over a handful of years. Now the S&P's up a little bit more, the NASDAQ's been looking pretty decent. But I think it's important to remember why this is happening. This rally really doesn't tell the whole story. We're getting a rally over the last 12, 16 or so months or so because we had to recover from how far the market fell off prior to that. So you might remember in 2022, it was one of the worst periods for stocks and bonds on history. In fact, the worst period for bonds in human history. So we had a lot of recovery to get back to, and it feels like, wow, things are up. But really, it's just recovering from where we were before. And we've seen this before. We saw this after 9/11. We had a period of 10 to 12 years of sideways movement in the market. Well, lots of volatility, but no real forward progress. So in your goodies bag, there are several charts and articles that elaborate on this, and one of the ones I just want to point out to you is this one. And it's a Dow chart, and I've marked on here where we were at the client dinner and where various things were so that you can kind of reference, what's really going on in terms of market performance. And if you factor in where we were and the ups and the downs and where we are right now, we've experienced roughly a 3.5% return from the client dinner in 2022 at the beach to roughly now. Lots of volatility in between, a little bit of growth, roughly equates to a 3.5% average rate of return. Not terrible, but not exactly great either. In fact, if you had your money in a money market or a CD, you probably would have outperformed the market. And I mention this, because our phones are ringing a lot and people are asking, the markets are up a little bit. How come my accounts are growing quite so much? And there's a couple of stories. But let's just recognize that this rally is being driven mostly by a handful of stocks. In fact, there's a name for it. It's called the Magnificent Seven. And not the Western movie, but the Magnificent Seven is a handful of large cap technology stocks that are responsible for the majority of what we are seeing. Facebook, Google, Amazon, Nvidia, Netflix, Tesla. So they now represent fully 30% of the capitalization on the S&P 500. The S&P 500 looks a whole lot like a large cap tech fund right now, rather than a broad representation of the economy. So, gosh, this is one of the reasons that I referenced the Dow Jones a lot instead of the S&P 500 when we talk about market performance. Recently, there was an article that came out that said, never mind the Magnificent Seven, it's now really only the Magnificent Three: Facebook, Google, and Nvidia. And then even more recently, there's another article that came out that said, never mind the Magnificent Three, it's really only the Magnificent One: Nvidia. Nvidia is driving really everything we are seeing in market performance. And of course, Nvidia is the company that makes the chips that makes the artificial intelligence and stuff work. And sure, AI is interesting, But NVIDIA is really the only company that is making money with artificial intelligence. And we saw this before too. When the internet was first invented, we have to build the pipes and the routers and the computers. So usually it's the equipment companies that make the money first before we figure out what to do with the thing that the equipment companies deliver. So Facebook, I'm sure they're doing okay in terms of profit for other reasons, but there's not a lot of money being made with artificial intelligence except for NVIDIA. We've learned it takes about 5 years for a new technology to roll out and for us to find out how to make money with it. So everything else, there's just a lot of speculation going on. In fact, there's very little evidence of real market breadth right now. In other words, there's the Magnificent Seven, but the other 493 companies on the S&P 500 might not be doing so hot. And that's not a good sign. In a healthy market, we would see everything, all boats kind of rise the tide, but we're really not seeing that. So the market is rising on the anticipation of things happening in artificial intelligence, the anticipation of the Fed's cutting interest rates, and that is by no means a certainty. And it seems like interest rates cuts are being delayed, and never mind whether cutting interest rates right now is good for the economy or not. Bottom line, we believe it is important not to get too excited about the market rally that we are experiencing right now. Instead, to look deeper at why things are happening the way that they are. More important, to understand where things are likely going to go next. Last week, there was an article that came out that says, stocks have become the game that a record number of Americans are playing, and legions of retail investors are flooding the market eager to chase volatile stocks. Investors are pouring money into companies with promising ideas, but very little profits. And that is what is driving the market. And haven't we seen this movie before? I think it came out in 1999. I think it was called the dot-com crash. So, in his book, 8 Centuries of Financial Folly, written by Carmen Reinhardt, he writes, more money has been lost by these 4 words than has been lost at the point of a gun. And those 4 words are, this time, it's different. Just a few weeks ago, someone called up my office and said, I want to sell out my entire IRA and put everything into NVIDIA. Not kidding, true story. Sell everything, put it into NVIDIA. I said, you do know that is crazy, right? She said, yes, I know that's crazy. So why are we doing this? Well, my brother made a lot of money with NVIDIA over the last few years. And, I kind of feel like I need to get ahead. Okay. I suggested she might consider moving her account to E-Trade, because that's not what we do. That's the furthest thing, that's the opposite of good financial planning and prudent investing. Now, I can't say whether they're going to lose money. I don't know if NVIDIA is going to go up or down, but it's just not prudent. It's not good financial planning. Our phones have been ringing a lot recently with people saying, how come my stuff is not up as much as the rest of the market is? And I have to say things like, in large parts because we're positioned on purpose in conservative investments, out of an abundance of caution, and probably rightly so. I believe moderately aggressive investors should probably have about half of their stuff in stable value or money market or fixed related positions. But just as many people who call and say, how come it's not going up as much? Other people are calling, thank goodness you have it in conservative and stable positions. I'm very happy with that. There's absolutely nothing wrong with making 5% with no risk right now for a little while. We'll see what happens next. So I'm not as worried about missing out on some big current market rally. I am more interested in trying to understand what's coming next, and maybe that's important to you also. We've squawked a lot recently about whether recession is coming, and the most reliable indicator of that is the yield curve. And the yield curve is a measurement of whether short-term and long-term interest rates are in the right place. We should have long-term interest rates higher than short-term ones. Right now, that's the opposite. It's called an inverse yield curve. And it is predicted every single recession except for one since 1955. So it's a pretty reliable indicator, and it's been glaring red since 2022. But still, the recession has been mysteriously absent. And one of our research firms recently said, you know, we think we might be a little bit behind the growth to recession and so forth curve than we thought. And this is the curve from, peak of the economy, down to recession, back to growth again. We might be a little bit further behind than we thought on the downside. And I know it's hard to say that because the market is obviously up and it's hard to argue with that. But the fundamentals of the market are not healthy. The yield curve is inverted. There are more warning signs out there than I can count. So we may have to look a little bit longer before we see true market bottom and a return to growth. But eventually, will it arrive? Maybe. I don't know that I frankly care. Will we get a soft landing or a hard landing? I don't think I frankly care. What I care about is, are we headed into a time of reasonable taxation, reasonable levels of growth, prudent governance, reasonable, stable, and economic geopolitical environment? Or do we think there will be challenging times ahead? Myself, our guest speaker, David, many others, we think we are heading into challenging times. 35 trillion and rising of national debt. Social Security is 65 trillion in the hole. Biden's budget, 7.6 trillion of budget, called an insatiable appetite for reckless spending. Our interest payments on national debt now exceed national defense and are very quickly approaching what we spend on Medicaid. There's a long list of reasons here I won't bore you with, and I'm sure Dave will talk about some of that. But many experts believe that in order to meaningfully address our nation's fiscal problems, taxes not only have to double in the next 10 years, but spending has to be cut. And that's basically austerity. When you combine these two forces, when you understand that the government spending fully represents about 25% of our gross domestic product, and then you take that punch bowl away, that likely leads for markets to struggle and probably for many years to come. I think that the days of the Tom Brady market, as in the best of all time, are very likely behind us and possibly not coming back. And then finally, factor in that most of us are very quickly, if not already in, our retirement years. And the question becomes, do we really want to take on a whole lot of risk anyway? Probably there comes a point in our lives where we stop chasing all the giant growth and realize we've achieved probably all the growth that not only we need, and that frankly we might get. So we probably shift from counting how many marbles we have in the bag to thinking about how much income can that bag of marbles reasonably generate? And that's a huge mindset change, I know. It's shifting from saving and investing mode to withdrawal and spending mode. And that is a giant change in thinking. And for a lot of people, it's a mind-melting concept. We've spent 90% of our financial lives growing the bag of marbles. And now we're changing into income mode and how to most efficiently access that bag of marbles, how much income they generate. That often involves a thought process that is new, can be challenging, and perhaps it takes some time to grasp. And that's why I'm glad we're talking. That's why I'm glad you're here. And sure, there's some exciting investments out there. There's AI, robotics, cloud computing, rocket ships, so we'll probably always have some investments that take advantage of new and cool ideas. If Elon Musk invents time travel, I'm probably going to want to invest in it. But for the can't screw it up money, I think I'm looking for stuff in this environment that is stable, predictable, reliable, tax advantaged, gives us a steady stream of income that allows us not only to survive, but thrive. in the years to come. In fact, I think this is so important. I think we will get more results by managing taxation than we will by managing investments in the years to come. And that's why we've been talking about Roth conversions and tax shelters an awful lot. And many of you have been asking, you know, we've been working together 15, 20, 25, even 30 years. How come we haven't talked about that stuff before? And well, we've always known about RMDs. We've always known that tax deferral is a problem. And frankly, we've been looking for the right tools to deal with this with. We even tried writing our own software. But it was incredibly complex, and we realized we'd never be able to keep up with all of the changes. And so that's why I'm very glad and very fortunate that we found the David McKnight Group, who understands this stuff very well and provides us with the tools and the expertise that we need to create solutions for our very best clients and friends. So if this is new to you, if Power of Zero, if Roth conversions, tax shelters, if all of this is new to you and you're just hearing this message for the first time, what should you be thinking about next? Well, how do you access these deliverables? First, I would encourage you to subscribe to our channel on YouTube. We've come to believe that YouTube is the best medium for us to deliver content to lots of people very quickly. And inside of your little bag is a little card with a code that you can scan. It'll take you straight to our channel, or you can just put Vaylark in the search bar, subscribe, like, you know, all the stuff, and you will get content pushed to you on a regular basis that talks about tax strategies, updates, and market outlooks and things of that sort. Second is to interact with the people here. I believe that this dinner, and this is why we keep doing it, is an important part of the experience of working with us. We can learn from each other. So we did a little bit of a secret squirrel thing here tonight with the carnations. If you have a yellow carnation, you are just getting started with the tax-free retirement philosophy. You might have gathered some data, we might have talked about a few things, but we haven't quite implemented yet. If you have a red carnation, that means you're further along. You've implemented some stuff. You might be a little bit more knowledgeable about things. All the white carnations, y'all are total newbies. But that's okay. Welcome. Welcome. So talk to the people around you. Learn from each other. And third, if you've never read The Power of Zero, please pick up a copy. We will have a ton of copies out on the back table here. Help yourself, put them in your bag, take one for your friends. We have plenty to share. If you've read The Power of Zero and you'd like to understand more of the mechanics and some of the next steps, take a copy of Ed Slott's Retirement Decisions Guide. We also have a bunch of those copies. Please help yourself. I'm very grateful to have formed a strategic alliance with David McKnight Group. I'm very grateful to have this team and this expertise and knowledge base to help us figure these things out. This is important. This will make a difference. And so with that in mind, ladies and gentlemen, would you please join me in welcoming our keynote speaker, best-selling author, thought leader, guru of all of this rigmarole, and generally a pretty nice guy, Mr. David McKnight.
Thank you, my friend.